Welcome to The Pit. I'm Iggy, forensic investor ranked 8th on Tiger Brokers among Singapore retail investors and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. Now let's get into today's numbers. The Straits Times Index is flirting with 5,000, but the real number that should keep you awake is 1.46%. That is where our one-safe T-bill sanctuary has collapsed to, mathematically rebooting the yield spread for every income seeker in Singapore. Today, we are doing a forensic rotation into equity risk premiums to find out who is actually swimming naked when the tide goes out. In this market, the difference between a true sanctuary and a yield trap is decided in a single trading session. We are seeing a massive rotation as yields melt down, and retail investors who are slow to react are going to be left holding the bag. By the time free subscribers read this digest, the entry window we have identified has already opened, and very often it has already closed. The margin of safety is incredibly razor thin right now, and you cannot afford to be looking at outdated numbers. If you are tired of constantly being exit liquidity for the institutional players, you need to fundamentally change your process. For just 9 Singapore dollars a month, which is literally less than a kopi and kaya toast set at Raffles Place, you can stop guessing and start being the analyst. Our elite community gets 0-day forensic breakdowns, the full red zone watch list, and institutional grade cheat sheets the exact moment the setup goes live. Do not wait for the news to tell you what happened yesterday. Take control of your portfolio today. Let us look at the market snapshot. The Straits Times Index closed at 4,996.05 on the 8th of April, literally knocking on the 5,000 handle. Regionally, the Hang Seng Index is trading in the mid-25,000, while the Thai SET is at 1,485. The SGX financial year 2025 daily average value stands at a healthy 1.5 billion Singapore dollars. The marine and engineering sector is dominating, with Yangzijiang, Seatrium and SIA Engineering leading, while Singtel and iFast are in the red. But remember the verdict, this final leg for the Straits Times Index is a marathon of earnings, not a sprint of sentiment. We opened the audit with a yield trap alert on Seatrium. Management has established a 3 billion Singapore dollar multi-currency medium-term note program for financial flexibility. Let us run the benchmarks. Net leverage sits at 1.1 times, easily passing our sub-5 times limit. But the forward yield is a miserable 0.66%, failing our 4.7% forensic hurdle by a full 400 basis points. They are trading at 25 times price to earnings, double the sector average, while peer Yangzijiang Shipbuilding maintains superior free cash flow. Looking at the forward risk for Seatrium, the balance sheet might be cleaner, but that $3 billion debt program is like an MRT door paradox. The door is open for growth, but leaning too hard on it stalls the dividend recovery. At a confirmed net margin of 2.5 to 2.8%, a 10% margin squeeze would erase roughly 25 million Singapore dollars in profit. The macro trigger to watch is a sudden downturn in global offshore rig demand or higher for longer refinancing costs. For a 45-year-old HDB owner in Bedok trying to supplement their salary, this combination of high valuation and low yield means paying a premium for a debt cycle that has not converted to cash yet. My forensic stance is a watch list trigger. Here is my insight on the debt cycle tax. Seatrium's $3 billion note program is not inherently dangerous. It is simply the price of operating at a massive scale in offshore marine. The forensic problem is the sequencing. You are being asked to pay 25 times earnings today for a yield of less than 1%, strictly on the promise that this debt cycle will eventually convert into distributions. That is not investing. That is speculating on a management execution timeline that you simply cannot audit. Yangzijiang has already done the hard work of converting its order book into free cash flow. Until Seatrium shows the exact same conversion, that $3 billion is a liability before it is an asset. The door is open, but the cash has not walked through it yet. Next up is another yield trap alert, this time for AMTD Idea Group. The board is exploring a stock dividend of listed subsidiary shares, but with absolutely no binding timeline or assurance of execution. Let us look at the cash yield. It is exactly 0%, failing the forensic hurdle entirely. Based on the SGX listed price against consolidated earnings, the price to earnings sits at roughly 1.29 times. But beware the transparency risk. Unlike an iFast, AMTD's dual listing structure carries significant opacity, making a single clean valuation figure practically impossible to state without massive qualification. The forward risk here is severe. A 10% drop in New York Stock Exchange trading volume could trigger a liquidity lock, making these proposed subsidiary shares completely impossible to monetize for retail investors here in Singapore. For a 50-year-old PMET in Jurong, this is a dangerous trap. The total absence of cash dividends and the non-binding nature of this stock plan offer absolutely zero sanctuary for university fee planning. My forensic stance is clear. This belongs squarely in the red zone. Let me give you the insight here. Free shares are not free cash. A stock dividend sounds like something for nothing. Basically the corporate equivalent of getting a double yolk egg at the wet market. But here is what the announcement does not tell you. The subsidiary shares being distributed are illiquid. Their realizable value is totally unverified, and the entire plan carries no binding execution timeline whatsoever. AMTD currently pays zero cash yield. What is being offered in its place is pure optionality dressed up as generosity. For that PMET in Jurong pricing university fees, optionality does not pay the tuition bill in August. Cash does. Until AMTD shows a path to sustainable cash distributions, the red zone verdict stands. Moving to our next audit, we have a yield hurdle failure on SIA Engineering. They just appointed an ex-DBS veteran as deputy chairman effective the 8th of April 2026. A banking veteran in the cockpit adds serious governance weight. The balance sheet reflects this discipline. It is net cash with debt to equity at roughly 5%, a genuine fortress. But the yield is approximately 2.9%, which flatly fails our 4.7% forensic hurdle. And they are trading at 24 times price to earnings, a premium to their mid-cycle average, especially when ST Engineering offers broader defensive coverage. The forward risk for SIA Engineering comes from the global maintenance, repair, and overhaul cycle. A 10% slowdown, potentially triggered by an aviation fuel price spike, would compress their 83.3 million Singapore dollar net profit, likely capping any dividend upside below 3%. For a 60-year-old retiree in Toa Payoh, this is a strategic neutral. The safety is undoubtedly high, but a 2.9% yield is a mathematical failure compared to the 4.0% CPF special account floor. Accepting equity cyclical risk for a yield that cannot clear a risk-free hurdle is not forensic discipline. Here is the insight on the governance premium that does not pay. The new board appointment is genuinely positive for the long-term governance trajectory. A DBS-trained banker at the board level brings balance sheet discipline the company clearly already practices. But governance quality and yield quality are two entirely separate audits. The forensic problem is simple arithmetic. The CPF special account pays 4.0% with zero equity risk. SIA Engineering pays 2.9% with MRO cycle exposure. You are being asked to accept more risk for less return. In Toa Payoh, they call that a bad deal regardless of who is sitting in the boardroom. Let us look at a success story with Link REIT. The triage audit shows they sold retail space at Thomson Plaza for 250 million Singapore dollars, a massive 23% premium to book value. Their Singapore rental reversion is confirmed at a very positive 12.9%. Selling at a premium like this is fair price house brand logic. Staple assets always command the highest ground. For a 55-year-old PMET in Punggol, this is capital recycling hard at work. While their Hong Kong assets remain under pressure, the Singapore core continues to operate as an absolute fortress. My forensic stance is fortress. My insight here is about recycling capital, not destroying it. What Link REIT did with Thomson Plaza is textbook forensic capital management. They identified a Singapore retail asset trading at a discount to its intrinsic value, held it until the market recognized that value, then sold at a 23% premium to book and redeployed those proceeds. That is not luck. That is the fortress playbook. The 12.9% Singapore rental reversion confirms the underlying demand is real, not sponsor engineered. For income investors in Punggol, the question is not whether Link REIT is well managed. It clearly is. The real question is whether the Hong Kong drag eventually erodes what Singapore is building. Let us talk about the analyst chatter. The institutional suits are blindly chasing the 5,000-point headline, but they are completely ignoring the melting yield spread. The institutional spin is cheering Seatrium's financial flexibility and SIA Engineering's board upgrade. But here is the uncomfortable truth. They are benchmarking against the T-bill rate that has collapsed to 1.46%. For my elite community, the benchmark has not moved. We audit against the return to long-term averages. A 2.9% yield was acceptable in a 1% world. It is a massive Kopitiam logic fail when the CPF special account still offers 4.0% risk-free. Before we look at the final yield spread, if you want my personal watch list updated in real time, you need to be inside Iggy's Elite Investors. We provide 0-day access to our proprietary yield calculators and full forensic cheat sheets so you never have to guess. Looking at the stress test buffer, we have Seatrium at 0.66% and SIA Engineering at 2.9%. For this audit, I apply a conservative forensic floor of 3.2%. While the T-bill sits at 1.46%, I do not lower my standards to match a temporary market dip. The minimum yield hurdle is 4.7%, representing that 3.2% floor plus 150 basis points of mandatory risk premium. We audit for the storm, not just the sunny day. Bringing it to the bottom line, the Straits Times Index at 4,996 is exactly like a Tampines HDB lift upgrade. It looks incredibly shiny and it moves you higher, but the foundation matters much more than the buttons. We are entering a thermal inversion in this market. T-bill yields have melted to 1.46%, yet blue-chip yields like SIA Engineering are stubbornly stuck at 2.9%. In Ang Mo Kio, retirees used to call that safety. I call it a missed opportunity. If you accept 2.9% in an equity with cyclical risk when your CPF special account gives you 4.0% for doing absolutely nothing, your forensic math is broken. We audit for the cash, not the applause. So here is the question you need to ask yourself today. Are you blindly buying the 5,000-point hype, or are you actually auditing the 1.46% sanctuary collapse? If you want the full breakdown on how we are trading this rotation, my 7-day embargo window is live right now. Join Iggy's elite investors using the link in the description to get on the right side of the trade. And here is your forensic punchline. In a market of melting yields, the investor with the 3.2% floor is the only one who will not get burned. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAS licensed financial advisor before committing funds.